The U.S. economy is at a critical turning point. A sharp 1.5% contraction in the first quarter of 2025 has rattled markets, sending alarm bells through Wall Street and Washington alike. And in the middle of it all, President Donald Trump. For years, Trump has clashed with the Federal Reserve, calling for low interest rates, aggressive monetary expansion, and economic growth at all costs. Now, with the economy slipping into dangerous territory, could Trump pressure the Fed to make a move that will change everything? What happens next will impact your money, your investments, and the future of the U.S. economy. Welcome to Finance Elevation. Let's break it down. The Atlanta Federal Reserve recently slashed its GDP projection, showing an unexpected economic contraction of 1.5%. Why does this matter? Because this kind of sudden downturn can trigger a chain reaction. Businesses pull back on spending, consumers tighten their wallets, layoffs begin to rise, and when that happens, panic sets in. Enter Donald Trump. With his Agenda 47 economic plan emphasizing growth, industry, and a booming stock market, Trump has every incentive to push the Fed to slash interest rates. But will they? Let's explore the three most likely scenarios of what happens next. In Scenario 1, the Federal Reserve buckles under economic pressure and moves to cut interest rates fast. The Fed could slash the federal funds rate from 5.25% down to 4%, or even lower. Why? Lower rates make borrowing cheaper, companies invest more, consumers spend more, the stock market surges. A 10 to 15% rally in the S&P 500 could follow, with tech stocks, real estate, and AI companies leading the charge. But here's the dangerous trade-off. Cutting rates too soon might send inflation skyrocketing again. The consumer price index could shoot above 3.5%, forcing the Fed to reverse course again, creating a roller coaster of instability. So, what should investors do? Increase exposure to high-growth sectors, hold long-term bonds which benefit from lower rates, reduce cash holdings and move into assets like REITs and equities. But what if the Fed refuses to play along? In Scenario 2, Jerome Powell and the Federal Open Market Committee stand firm. They decide no rate cuts, no political interference, and prioritize price stability over short-term gains. So what happens next? GDP growth stagnates at just 0.2%, barely above recession territory. Unemployment jumps from 4.2% to 5.5%, especially in manufacturing and construction. Markets react with panic. Defensive sectors like healthcare and utilities outperform, but growth stocks suffer. Shift to defensive stocks like consumer staples, healthcare, and utilities. Maintain a balanced mix of equities and fixed income investments. Hold cash reserves to take advantage of market dips. But what if Trump takes matters into his own hands? Now let's talk about the most extreme scenario. What if Trump directly pressures the Federal Reserve? Trump has a history of attacking the Fed. What could this mean? Trump publicly shames Powell, demanding rate cuts. Trump replaces key Fed officials with loyalists. The Fed loses credibility, leading to global uncertainty. Short-term relief rally, but long-term volatility soars. U.S. Treasury yields spike, as foreign investors demand higher returns. The dollar weakens, making gold and commodities more attractive. What should investors do? Hedge with real assets like gold, commodities, and real estate. Increase international exposure to reduce dependence on U.S. policy. Stay away from long-term U.S. bonds, which may lose value. But how does history inform what happens next? History tells us that when presidents interfere with the Fed, things rarely end well. Nixon pressured Arthur Burns into rate cuts, leading to 1970s stagflation. Reagan resisted interfering, letting Volcker end hyperinflation at a cost. Trump attacked Powell in 2018, but the Fed largely held its ground. So, what will happen this time? That brings us to the final takeaways. The Federal Reserve's next move is the biggest financial decision of 2025. Here's what you need to know. If rates are cut aggressively, expect a growth stock rally, but also higher inflation. If the Fed holds firm, defensive investments will outperform. If Trump intervenes, gold, commodities, and international stocks become the best hedge. The coming months will test the Fed's independence and the U.S. economy's resilience. What do you think will happen? Drop a comment below, subscribe to Finance Elevation, and stay ahead of the financial curve.